Global markets have been experiencing extraordinary volatility in response to the U.S. tariff pause announced on April 9th, a reflection of the uncertainty surrounding the economic and policy outlook. But similar to other unprecedented market moments in history, the investment strategies that work today may not apply tomorrow. So how can investors adapt their investment approach when the familiar economic rulebook is thrown out?
The similarity here is that we're seeing something that we have never seen before. We just had the 5th anniversary of COVID. We've seen a rate of change in events in the market that pretty much you could all describe as unprecedented. It's made us really think about how we can use the data that we have at our disposal to answer these emerging investment questions in a way that is very differentiated, that maybe we wouldn't have been able to do before.
Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido. Coming up on The Bid, we continue our market coverage, following tariff policies and their impact on the global markets. We're recording this episode on Tuesday, April 22nd. To help us put these market events into context, I'm joined by Rich Mathieson, a senior portfolio manager within the Systematic Active Equities team, a quantitative investment group at BlackRock. Rich will take us through some of the pivotal moments in history where uncertainty was a catalyst for transformation in the insights and strategies used by investors. He'll share how that's playing out in markets today, including the data and techniques that can help investors cut through the headline noise. Rich, thank you so much for joining us on The Bid.
Thanks, Oscar. Lovely to be with you.
Rich, we've actually spoken to some of your colleagues in the systematic investing business in the past, people like Jeff Shen, people like Brad Betts, and we've talked to them about how your teams use big data and artificial intelligence to go about looking for investment opportunities. I'd love to ask you if we take a step back and think about what's been going on in the markets very recently. We've had a lot of volatility. We've had a lot of news around trade policy, foreign policy, news coming out of the U.S. How do you think about this period relative to other historical periods of uncertainty?
Yeah, I think there's maybe been 2 or 3 unique features of this particular episode. I think the first one would be the speed at which it's evolved. The start of 2025 seems a long way away, but it was only really 3.5 months ago. We started the year with a white-hot US economy, equity markets all-time highs, inflation coming back towards Fed target, and generally a sense of bullishness across the investor base. Fast forward 3.5 months, things are very, very different. If you look at macro and investor sentiment levels, they've completely capitulated. Interest rates are higher than they were at the start of the month. Inflation expectations are rising. And actually, for many investors, recession has become a likely bear case scenario, if not a base case scenario. So things have changed very quickly. And the way that we've seen that play out in our data is that it seems like a lot of investors have been taken by surprise. If you look at measures of riskiness around popular momentum trades and crowded hedge fund positioning, they are flashing very, very red at the moment. And that's leading us to rotate our portfolios quite significantly away from some of the winning trades from the last 2 or 3 years. A second feature is the starting point. No matter how you cut it, valuations, particularly in equity markets, were very, very rich. That was particularly the case for US assets. And it's somewhat sobering that even with a peak to trough drawdown of 17% on the MSCI World, as we've seen during the month. And then the final, and I think maybe the most pertinent point, is that in this episode, investors, I think, have found it a lot more challenging than normal to isolate sources of defense to protect their portfolios. If you think across that level, normal safe havens, dollar-denominated assets, particularly US Treasuries, have not given the ballast that investors would have hoped for. When we drill into the equity markets, areas like high-quality tech that have been sources of defense in the past, if anything, been more at the epicenter of the downturn. And then even more traditional defensives, thinking pharmaceuticals, consumer staples, in many instances have brought you into the crosshairs of escalating trade tensions in tariff policy. And so you've had to think very, very carefully about where defense sits in your portfolio, how to measure it, how to get exposure to it. And that has been one area where data has given us a very nice edge.
And Rich, are there any similarities or differences to other periods in the past where we've seen volatility, periods like COVID or even market corrections that we saw in the 1990s, perhaps? I'm just curious how this compares to history.
The similarity here is that we're seeing something that we have never seen before. If I think over the last 5 years, we just had the 5th anniversary of COVID back in March. And I think in the 5-year period since then, we've seen a rate of change in events in the market that pretty much you could all describe as unprecedented. We had a lockdown, we had a global pandemic. We then had vaccines and a reopening of the global economy that none of us have seen before. We then had inflation and interest rates rising at levels that haven't really been observed since the 1970s. You then had the introduction of big secular themes like artificial intelligence. And then more recently, obviously, the escalation in trade tensions that very few of us have seen the likes of in our careers. The one thing that all of these episodes have had in common is that they have been unique, they have been different. It's made us really think about how we can use the data that we have at our disposal, the technology stack that we've built up over the last 10 to 15 years to answer these emerging investment questions in a way that is very differentiated, that maybe we wouldn't have been able to do before. Great example, I think about artificial intelligence. January 2023, we were actually underweight or short NVIDIA across most of our portfolios. NVIDIA came out and produced earnings that were significantly above expectations, and they attributed it to artificial intelligence. Now, we had been using artificial intelligence to build models, to build signals, to pick stocks. So we were already adopters of the technology, but it was the first time we had really seen a company monetize the opportunity in the way that NVIDIA clearly were back at that time. And then pretty much Q1 23, every single technology stock in the market claimed they were investing in artificial intelligence and they were going to be the next NVIDIA. And it was quite clear that our models hadn't quite picked up on this emerging opportunity. We were actually poorly exposed to the companies that were rallying on the back of the NVIDIA earnings. And so we went back and we asked ourselves the question, who are the other companies that are going to be like NVIDIA, that are going to be able to monetize this opportunity in the near term? And who are the ones that are saying they're doing it, but maybe are just riding the wave? And we were able to answer that question by going to our data. So we looked at 2 years worth of earnings call transcripts. We looked at 2 years worth of online job postings and hiring. And we identified the companies that had been talking about artificial intelligence and hiring for skills, occupations, talents associated with artificial intelligence. And we identified the companies that weren't doing that, but essentially said they were doing it in their Q1 earnings call. And that enabled us to navigate the evolution of that secular theme. It became a very important driver of return dispersion across the US equity market through 23 and a lot of 2024. Fast forward to this most recent event, clearly the questions we're asking ourselves right now are, who are the companies that are going to be the most exposed to trade tensions, to tariffs, and who are the companies that are somewhat immune? And again, we've been able to go and query the data stack that we have to answer that question. Now, this has been a little bit more challenging because ultimately the question of tariffs in trade comes down to costs in manufacturing. And typically companies don't give you a lot of information about where they incur their costs and where their operations are based. They'll tell you a lot about where they're selling, but you don't get that cost analysis. And so we've been able to go back to the data, and we've been looking at data sets such as geolocation data, online job postings. That has enabled us to identify that relative to sales in the US, where companies are hiring, where companies are present, where they're potentially manufacturing, where they're based, versus maybe, for example, companies that sell a lot in the US but have a lot of their operating costs or evidence of their operating costs in other countries. Shipping data gives us a sense for what companies are importing from overseas into the US versus the ones that are more reliant from domestic production. And so analysing the data in that way, we've got a sense for where American companies' operations are relative to their sales versus those that are maybe more exposed internationally to production bases and supply chains. And if I look at the types of signals that have navigated this recent episode very well, those have given us a fantastic edge. And being able to query a very expansive data set that we've been investing in over the last 15 to 20 years has been able to navigate these very changeable markets that we've seen now for coming up in 60 months.
You mentioned that one of the commonalities between the recent market volatility and maybe some past episodes is just how unprecedented those moves have been. In fact, I think the use of the word unprecedented is at unprecedented highs.
Overused.
Absolutely. But it goes to show just how unique of an environment we're living through. And I think what you're touching on is that there have been then advancements and innovations in how your team uses data to analyze some of these periods that we're living through. I think those are some of the examples you're mentioning.
Absolutely. And I think the big change that we've seen in our approach is just the need to be a lot more dynamic in how you're using the data and the questions you're asking the data, essentially bringing in an element of dynamism into your research process to make sure that at all times it is very market aware, it is reflecting whatever theme is prevailing and making sure that you have some exposure to that, at least in your portfolios, even if it's a worst case scenario, just a risk control to make sure that you don't have any gaping holes that you're exposed to.
And so, Rich, shifting gears a little bit to just where we are now in the current environment, how are you interpreting the data, or what is the data telling you about the range of potential outcomes for markets, the economy, and policy?
In terms of very high level, I would say through the first quarter of the year, a lot of our top-down macro models did start to move slightly more defensive. Here, I think the more traditional macro models are looking at vectors of returns across all asset classes, equities, fixed income, credit. We're overlaying that with the most recent economic releases, and then we're taking all of the current data and saying what period historically most resembles what we're currently seeing. Now, as we came into 2025, a lot of that analysis was pointing to a fairly mid-cycle constructive regime. I would say, if anything, it's starting to look a little bit more late cycle. And so we had already been moving portfolios to be a little bit more defensive. So buying up defensive large cap size, selling down high risk, high volatility. I would say currently, if you look at all of that traditional data and you put it together and you flip it on its head and you look at the current data and look at the data that prevailed 6 to 12 months before every recession, you can reverse engineer a probability of going into a recession in the next 6 to 12 months. That has gone up, but based on the traditional data, it still looks somewhat muted, somewhat benign. Having said that, we're very aware the speed at which the world has changed is probably a lot more rapid than we've seen in previous episodes. And so we're continually monitoring, I would say, higher frequency data. For example, go back to online job postings, gives us a good sense of where starting salary levels are moving. And we're seeing some evidence that wage inflation that consumers have benefited from is maybe starting to roll over. And it's actually maybe some evidence of it starting to roll over where it really counts in the high income brackets, but nothing that gives us too big a cause for concern just yet. So for the time being, we're still recession, not the base case, but we're very focused on a lot of that higher frequency data to give us an early sign of where the core top-down models might move towards.
Right. So recession is not the base case, but the data is starting to tell you that maybe that's a more likely scenario than it was at the beginning of the year. Notwithstanding that, Rich, plus the fact that you've had volatility, one of the messages that we've been conveying in some of our recent episodes around this period of market volatility is the need to stay invested, but perhaps what you're invested in starts to change in this environment. What are some of the investment opportunities that you and your team are seeing?
Yeah, I think in the near term, we've got volatility now stabilizing to a certain extent at reasonably high levels. If we look out 3-6 months from now, something that I'm reasonably excited about is you are starting to see the concentration in global equity markets break down to a certain extent. I mentioned earlier some of these highly profitable large cap tech companies that have led markets down through this episode. That is improving the breadth of the overall market. But in all honesty, a world where being long 7 stocks and short everything else is the right answer doesn't really lend itself too well to a systematic approach that is really designed to exploit a much broader opportunity set across global equity markets. And I think as we go forward from here, I would expect to see breadth in the US market improve. That will follow what we've already seen in areas like Europe and Japan, and that has significantly improved the opportunity set just to identify the winners and the losers in those markets. I fully expect the US market to follow as we move beyond this latest episode. Breadth will improve and the opportunity set for stock selection will improve.
Right. More breadth means more opportunities for active managers such as yourself to try and outperform some of the benchmarks that maybe in the past couple of years have been a little bit more difficult to outperform because of the narrowness of the companies that have been outperforming that benchmark. And Rich, it's clear from listening to you that we're in unprecedented times, to use the term, and the volatility that we've seen is not something that has a lot of historical precedence. You also mentioned that one of the observations in markets recently was that the areas of the market that have traditionally served as safe havens or flight to qualities have behaved a little bit differently than they have in the past. So what does this mean for portfolio construction when we think about the path forward?
In terms of just equity portfolios, we've had to work harder to identify the sources of defense. I think more broadly from an asset allocation point of view, you just had 2 years of 20% plus returns on the S&P 500. That's very, very unusual. And I think we'd already started to see before this recent episode, I think capital market assumptions been revised down. And the way that that's played out for our platform is we've seen growing demand, maybe a shift in allocation, coming back the other way from passive investors being prepared to embrace active management again. So we've seen investors start to embrace active management, just move up the risk curve a little bit to capture that driver of return. I think the other aspect, and I think this comes back to the heart of your question, Oscar, the other aspect of capital market assumptions that has been changing, and I think this goes back to what we saw even in 2022, which was maybe arguably the most similar episode to the one that we've seen currently, the diversification investors can expect to obtain by allocating traditional asset classes, namely equities and bonds, has been revised downwards. And again, you've seen a period recently where both of those asset classes have been losing money at the same time. And that has led many of the investors we speak to embrace or look for alternative sources of diversification, alternative sources of ballast in their portfolios that can produce a very uncorrelated source of alpha, even in markets that are going down, as we've seen so far year to date.
Well, Rich, we know that investing is a very emotional exercise for a lot of investors, and it's always reassuring to hear when people like you and your team are really looking at the data to make sense of how to navigate these complex dynamics. You also mentioned alpha, which is hard to generate, but you're saying that now this is an environment where you think is perhaps possible given some of the volatility that we're seeing in markets. So, Rich, thank you for sharing all of this context with us, and thank you for doing it here on The Bid.
You're welcome. Thanks for having me, Oscar.
Thanks for listening to this episode of The Bid. Next week, Catherine Kress joins us to discuss the latest in geopolitics. Make sure to subscribe to The Bid wherever you get your podcasts, and don't miss an episode.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.